Welcome to Meet the Manager. My name's Frank Casarotti. I head distribution at Magellan Financial Group. Today we're going to hear from Hamish Douglass, who's the co-founder and, more importantly, the portfolio manager for the Global Fund. Hamish, talk us through the investment philosophy for the Global Fund.
Well, before I start with the philosophy, I'll really start with the objectives of the fund. Our first and I think most important objective is we're trying to minimise the risk of a permanent capital loss. As you know, we're a long-only fund. That doesn't mean we're trying to take out all stock market volatility, but what we're trying to do is we're trying to minimise what we call event risk within the fund, and we're really talking about the events that can occur. They could be a macroeconomic event like the financial crisis that happened in 2008 and 2009. We actually sold almost completely out of all banking stocks just after the collapse of Lehman Brothers, and we ran the fund at 30% cash during that period. That was because we have an objective of not losing people's money in the fund. It's the most important objective that we have. That doesn't mean the fund couldn't go down in a period of time when stock markets are going down, but if we own businesses where we have no concern about them being permanently impaired in their value, or that risk, the financial crisis wasn't going to harm the long-term consumption of Coca-Cola, we didn't sell our Coca-Cola shares. But it was potentially going to be catastrophic for banking institutions around the world, and we weren't prepared to wait around with that risk. Once we're focused on that minimisation of risk, we then very much focus on the return for our investors. There's no use minimising risk and not delivering people any investment return. Ultimately, people need a return on their funds. And our objective, which is unusual for a long-only fund manager, our objective is an absolute return objective. And our objective is to deliver people a performance over the medium to long term of a minimum of 9% per annum, net of any fees that we would charge in the fund, which of course means we have to get slightly more than 9% per annum from the fund itself. And that means every investment decision we make, we're not trying to make short-term decisions about outperforming the market in a particular quarter or over a year and making sectorial calls. We're trying to make decisions about, will that investment, being low risk, deliver a return over the next 3 to 5 years of at least 9% net of our fees. And that's how we think about our objectives. In terms of the philosophy of how we go about this, our philosophy is actually quite a simple philosophy, but not practiced by a lot of people. Our philosophy is to invest in a portfolio of simply outstanding businesses, and businesses that we say have huge long-term and sustainable competitive advantages. They could have huge market shares or brands. They could have patents protecting them. They could have government regulation or concession deeds protecting them. But we're looking for some real competitive advantage, and we're wanting to be in businesses that have very attractive economics. Capitalism is very brutal over time. Businesses that appear to be very attractive, along comes a deep recession, competition comes in, margins disappear, and the business is no longer attractive. We're wanting fairly unique businesses that have such wide competitive advantages, which we call economic moats. That's sort of a Warren Buffett term. And we are looking for these very, very advantaged businesses with these wide economic moats that have very attractive returns. And we would say that if you paid a fair price for these businesses and were right on their assessment of their long-term competitive advantages, the chance of permanently impairing people's capital investing in that type of portfolio is pretty remote. And then what we do in our philosophy, we're focused on 3 sectors. So we want to have an advantage, a competitive advantage ourselves, an analytical advantage, and that's why we focus. We focus on 3 sectors only. We focus on the large franchise or largely consumer sector around the world. There are a lot of businesses around the world that have built up very, very large brand advantages over time in that space. But they could be the healthcare or pharmaceutical sector as well. They could be the e-commerce sector or the tech sector, as well as the large retailers and consumer companies around the world. We're focused on financials around the world. They're just not banks. They're payment card networks. They may be stock exchanges around the world. Of course, insurance companies and asset management companies. It's a very large sector. And then we concentrate also on the global listed infrastructure sector. These could be ports or airports or utilities around the world. And in each of these sectors, we've got expert teams leading the research, and we call that our circle of competence. And then, as I mentioned, we run a relatively concentrated portfolio. We're buying 20 to 40 stocks. I think of it at 25 stocks. I call it a football team. And I want to make sure we've got the best players on the paddock at any point of time that are going to try and deliver our objectives. I could buy 50 or 100 of these companies, but I'm actually diluting the chance of realising the objectives we've set for this fund.
Hamish, what are some of the themes and major positions within the portfolio at the moment?
Well, the most dominant theme in the portfolio would be our laser-light focus on what's going to happen to the consumer in the major emerging markets over the next 5, 10, 15, even 30 years looking out. There is a mass urbanisation and development of a huge middle class in countries like China and India, Latin and South America, Southeast Asia occurring at the moment. A lot of people have played the emerging markets aimed at what's really been their development to date, which has been a build out of their infrastructure and their property assets. We call that the fixed asset investment story. The future of these markets, in our view, is going to be very dependent on what happens to their consumer expenditure and the rising wealth in these markets and the next billion consumers that start consuming goods and services. And we have almost 50% of the portfolio. We've been very consistent having almost 50% of the portfolio in major global multinational consumer franchises that have extreme competitive positions and market shares in every one of these major markets, be it India or China or Brazil or Mexico or even Russia and other places. These companies have the dominant market shares in what they do. Examples would be a business like Yum Brands. Yum Brands people may not have heard of, but it owns KFC, Pizza Hut and Taco Bell around the world. Almost 40% of this company's profitability already comes out of China. And they have 3,500 restaurants, predominantly KFC stores. They believe, and our analysis tells us, over the medium to long term, maybe there's a market opportunity of 15,000 to 20,000 KFC stores in China. And they're earning around a 40% pre-tax return on the capital they're putting into that business. That's one hell of a business to be invested in, and it is very, very likely to occur. Other great businesses that we own in this space would be Procter & Gamble, which I think is the world's most diversified large-scale consumer products company. They're in businesses, they're the world's leader in shampoo. They own Head & Shoulders and Pantene, Wella, Clairol, Herbal Essences. They're the world's largest diaper manufacturer. They own a big brand called Pampers. They actually have 75% worldwide market share in disposable razors. Most people have probably heard of Gillette. They've got many other businesses. We also own shares in large positions in the top 10 in businesses Coca-Cola and Nestle and Colgate, which has 50% of the world's toothpaste market. These are very, very advantaged businesses. Other large exposures in the top 10 are businesses that people have probably heard of, but they're businesses where we really don't think Australians get exposure. Our largest exposure at the moment is actually in a US banking stock called Wells Fargo. They bought a bank in the United States at the depth of the financial crisis called Wachovia that virtually gave the duplication of their business on the east coast of America. They were largely a west coast franchise. They largely got a retail banking franchise as large as their own, and they virtually bought it for nothing. Obviously, there were some problem loans there. I think it's going to go down in history as one of the best, if not the best, large-scale acquisition in history. We're very, very optimistic around what's going to happen to Wells Fargo in the next few years. We've got a very sizable position in that banking franchise. We also own shares. Our second largest investment is eBay. eBay, e-commerce may go from 5% of current retail expenditure around the world to maybe 15 to 20% of retail expenditure in the next 10 to 15 years. That is a huge growth opportunity. There are going to be competitors in that space, and there are already some very formidable competitors, but there are going to be many winners in that space. And eBay is going to be one of them in our view. But the business we really like in eBay is a payments business called PayPal, which is an electronic wallet payment mechanism, largely in e-commerce at the moment. There are probably only 4 or 5 ways you can pay in e-commerce at the moment, and one of them is PayPal. And PayPal is literally collecting a royalty over e-commerce expenditure. And I mentioned e-commerce expenditure may go from 5 to 15 to 20% of the world's total expenditure in retail. And there's a royalty flow going to PayPal, as well as a few other payment mechanisms. And we also believe there is an enormous potential opportunity in the non-e-commerce world, known as the offline expenditure world, where as these smartphones develop, you could actually have people no longer actually swiping their credit cards, but really swiping their phones at the terminals. This technology is literally here today. It's going to be in the next generation of the iPhone 5. It's going to be in the next generation, which are soon to be released, of the Android, Google-powered devices for the rest of the smartphone world, absent the Nokia system. Well, I'm sure they'll put this technology in. There is just an enormous opportunity for alternative payment mechanisms, and we think PayPal is very well developed in that, in the rest of the world's expenditure, outside to the 15 to 20% I spoke about in e-commerce. So there are a few themes we've done. We tend to be very consistent over time. We think each of these businesses I've spoken about have huge long-term sustainable competitive advantages. We think they're very attractively priced regarding our 9% return objective over the medium to long term. We're not saying they'll generate that in the next 12 months. It will depend on what markets do, but over the next 3 to 5 years, we think these businesses are very well positioned to deliver returns with pretty low risk for our investors.
Thanks, Hamish, and thanks for listening, and we look forward to staying in touch with you in the future.